Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. You're still looking at a mixed picture here as we head into the final hour of trading. Dow holding on to gains up just over 100 points. S&P and Nasdaq, though, lagging behind. You're looking at the Nasdaq off just about 1%. Technology, communication services, the worst performers in today's trading action. Energy, the best performing sector so far. Well, the S&P 500 briefly crossing into bull market territory earlier today in the session, but has since pulled back. Jared Blickery is at the big board with a closer look at some of the moves we're seeing today, Jared.
Yes, a couple of standouts here. Guess what? We got the Nasdaq down about 1%. Big standout is the Russell 2000, that's up 2%, and also the Dow is up 0.3%. And this is tracking a shift in the market that I've seen since last Friday. Now, let's take a look at the sector action where we see energy. That is in the forefront. That's up about 2.6%, followed by the defensive sectors, utilities, real estate. Then we get industrials, materials. These are cyclicals and financials. That's value. So really a rally fang value and cyclicals and a little bit of defensives over everything else. What's taking a backseat today? XLK is tech. That's down 1%, along with communication services and consumer discretionary down about 0.5%. These three sectors right here are the mega cap sectors. So guess what? That shift at the expense of mega caps. Now, let me just take a look at volatility here, and we can see the CBOE Volatility Index, the VIX, is still down at multi-year lows right there. We can also take a look at the B of A Move Index. This is like the VIX for the bond market. That has been edging down as well. So impressive to see that. It's favoring, and this isn't necessarily like the previous rallies we've seen, but the rally is favoring a broadening out such that value and cyclicals are once again brought into the fold. Now, the strength of this thrust, we have 3 days going back to Friday where the Russell 2000 has been up more than 2%. Haven't seen anything like that since November of 2020 when we had the presidential election and people were excited about the infrastructure play with Biden coming into office. That was a really long time ago, but I just want people to realize that this could have legs. Now, what could weigh on the situation? We got CPI in a week. We also have that Fed meeting. Anything can happen there. But in the meantime, things are setting up for a bit of a squeeze to the upside. I should also say that positioning among a lot of market participants is short right now. And so this is amounting to a pain trade. And we're seeing the pain right now in Amazon. That's down 3%. Alphabet down 3%. Not necessarily across the board. And this doesn't have to come at the expense of all these guys. But ideally, in a bull market, you want to see a broad participation, something we have not seen this year until very recently. So does this continue? It's going to depend on some of the macro stuff like CPI and also the Fed meeting, as I said. But in the meantime, tactically, this has more upside potential.
All right, well, I guess that's good news for the investors out there. All right, Jared Blickery, thanks.
Well, with just 1 week to go until the June FOMC meeting, the Fed watch tool showing a 69% chance for a pause. But where do the committee members currently stand? For a breakdown on that, let's bring in Yahoo Finance's Jen Schomburger. Jen, feels like the momentum has really swung in the expectation of a rate hike here. What are we looking at?
Hey there, Akiko. When the Federal Reserve sits down to decide whether to raise interest rates again next week, it will likely be a game time decision. Fed Chair Jay Powell has said that interest rate decisions will be made on a meeting-by-meeting basis. With a key data point, the Consumer Price Index for May due out next Tuesday, the first day of the Fed's policy meeting, officials will need to decide whether the 10 interest rate hikes done so far will be enough in time to cool inflation or whether more action is needed now. Coming into this June meeting, officials were divided ahead of the blackout period that started on Saturday. In that pause camp, if you will, Fed Governor Philip Jefferson and Philadelphia Fed President Patrick Harker suggested last week that the Fed could pause rate hikes at this next meeting. They both noted that such a decision wouldn't necessarily mean that the Fed is actually done hiking rates. Harker, for his part, reserved his decision based on data he had not yet seen at the time, namely the May jobs report, which clocked in stronger than expected, and the upcoming CPI number. Also in that pause camp, Boston Fed President Susan Collins and Atlanta Fed President Raphael Bostic. Now, on the flip side, a handful of members still see the need to hike rates. In that camp, St. Louis Fed President James Bullard, who said he thinks the Fed should do 2 more rate hikes, while Dallas Fed President Lori Logan has said a pause is not in order, though she said that could change depending on the incoming data. Also in that hiking camp, Fed Governor Michelle Bowman, Cleveland Fed President Loretta Mester, and Minneapolis Fed President Neil Kashkari. Back to you.
Jen, some Fed officials there not included on those 2 lists. I'm assuming that means that they're still on the fence. Where do they stand?
Hey there, Shauna. Yeah, there are a consortium of Fed officials who want to keep their options open, don't want to be pinned down heading into that meeting. And part of that group, Fed Chair Jay Powell, also in that camp. New York Fed President John Williams, Richmond's Tom Barkin, San Francisco's Mary Daly, Chicago Fed President Austin Goolsbee, and Fed Governor Chris Waller. As of this afternoon, as you mentioned, the markets are pricing in a 70% chance of a pause next meeting. We know that the Fed typically does not like to surprise markets. Of course, a lot could change depending on that CPI number out next Tuesday. Ladies?
It certainly can. Jennifer Schomburger, as always, thanks so much for that.
Thanks.
All right, here with more on what to expect from the Fed next week and the market implications, we want to bring in Amy Kong, CI Barrett Private Wealth Chief Investment Officer. Amy, it's good to see you here. So we just heard from Jen Schomburger that Fed officials are split, those who have voiced their decision. Many are on the side of the need to raise rates once again. Some are saying it's time to pause. What do you think makes the most sense to do now?
Hi, guys. Thanks for having me. I think I wouldn't be surprised if we saw another hike at the next FOMC meeting. We very much saw a very strong jobs report last week. And we also saw that the Bank of Australia as well as Canada both raised. And the idea is inflation is still high compared to the Fed's target rate. And the economy is still strong enough, still provides us that flexibility to raise rates. There's still strength in the jobs market, wage inflation, you name it. And so, again, I would not be surprised if the Fed were to raise it one more time by 25 basis points.
Yeah, what is your expectation now on how high those rates can go and how long they're likely to last?
Yeah, I think the Fed is looking at data points, and so are we. It's hard to project out with every data point being so critical. And again, based on what we're seeing with the jobs report that we saw, as well as some of the previous CPI numbers, it just seems like the fight to control inflation is not quite yet over from what we're projecting out.
What do you think the market implications are for this? Are they priced in order to be able to handle another 25 basis point hike if we do see one next week?
My speculation is that the market might not like it. As you've pointed out and others have pointed out, the Fed funds futures are suggesting that over 70% of participants think a pause is likely for the next FOMC meeting. And so if the Fed is to raise it, I think the market may certainly reflect prices downwards as a result of that. But I don't think necessarily that we would see a huge market downturn. Perhaps, we've also seen the market rally to this degree at the top end of this range that we've been seeing. It really would not be a surprise to us if participants took some profits off the table as well.
Let's talk about what we've been seeing in the markets. It feels like we're back to sort of tech being a big crowded trade here, with AI being a big focus. How have you been approaching that in terms of an investment side of things? And is it really still about the big names like an NVIDIA or a Microsoft?
Yeah, we see AI as part of a very long mega trend. And so we do think that having exposure to this trend makes sense to us. NVIDIA is obviously the top way of getting into this particular trend, if you would, and we do have ownership of that stock. We like Microsoft as well, not because they're making any chips related to AI, but certainly they are making the right investments. And of course, with regards to Google and others, you will have some exposure as well, but our top exposures would be NVIDIA as well as Microsoft. And NVIDIA is an interesting play to us because not only is it going to capture the benefits of this AI trend, but other types of trends as well, whether it's cryptocurrency. I know it's taking a little bit of a lull at this point, but certainly any kind of trend that requires more and more semiconductor chips, whether it's gaming or what have you, I think NVIDIA would be a very good end benefit of these types of trends.
Amy, what do you make about the broader hype excitement around AI that we have certainly seen over the last several months? Do you think some of that seems to be a bit overdone at this point?
I think there's likely to be some momentum fading at some point, and there is risk that, ultimately some of these AI-driven results may actually be a risk in the sense that some of the outputs that we've been seeing could be, could be wrong or factually needs improvement, and there could be some headwinds along the way. But as a trend for the longer term, I can understand that there is hype to it. This is a very long-term kind of trend that we can see being applied not only to technology, but to a lot of industrial and a lot of, typical companies as well. And so this is definitely a little bit broader than, crypto or anything that we've seen in the past. And so we can understand the excitement, but we are also very selective that, you certainly want to pick your price points in terms of getting into some of these stocks that I've mentioned as well.
Yeah, and the question I think a lot of people asking, aside from the names like NVIDIA and Microsoft, how do you pick that price point to get in on? Is it about profitability? I mean, what are the other things in the wide swath of names that have used AI as a buzzword? Who do you know where to put your money behind?
Absolutely. And that's why we try to stick with some of the larger companies, because you certainly can get it wrong if you stay with smaller players or, certainly a lot of these players are not even publicly traded. So the universe of names out there is somewhat limited. And we try to stick with the larger players just because we don't have a crystal ball to understand when's the best time to get in. We just know that for a company like Microsoft, as another example, while we certainly like the AI trend, we also realize too that Microsoft is just a pure innovator in that sense, and that they, have the wherewithal to make the bets on behalf of investors into AI and other types of trends. And so that to us is an appealing attraction. And then as well as NVIDIA, I recognize that the price may not be as attractive today, but certainly there, if you look at the history of NVIDIA, you will find windows of opportunity to get in. Again, this is a very interesting trend, but it does whipsaw back and forth. And I would encourage investors to not necessarily put all their eggs into one basket immediately, but really divide their money into tranches in terms of getting into names like NVIDIA, which can be volatile.
Amy, speaking of diversification outside of technology, how are you advising your clients and how they should be positioning their portfolio?
Absolutely. So we typically look at individual stocks, and we wouldn't wake up saying we have to have X% in a sector or subsector. And so to us, what makes most sense in this kind of world that we're in post-COVID, inflation still somewhat higher than target. And of course, we're kind of edging our way into a potential recession. We're really looking for companies that can manage through these scenarios. And the characteristics we're looking for include pricing power and the ability to manage expenses. So really the ability to pull levers to manage top line and bottom line. And then, of course, as we're heading into this economy where rates will likely stay higher for longer, we're less keen on companies that have to go out to the capital markets to raise capital, whether it's debt or an equity. And I think companies that can check off these boxes can certainly, in our opinion, weather the storm that we're seeking to materialize over the next 12 months or so.
Amy Kong, CI Barrett Private Wealth Chief Investment Officer. Appreciate you stopping by today. Well, we are just getting started here on Yahoo Finance Live. Coming up, we're discussing the emerging trends shifting the commercial real estate landscape with the Chief Revenue Officer for WeWork. Plus the merger between the PGA and Live Golf in full swing now. We're going to break down the impacts of the deal on the other side. And GameStop set to report earnings after the bell. We'll check in on the stock and break down the numbers from the gaming retailer later in the show. Much more to come here on Yahoo Finance Live. We'll be right back.
the SEC suing Coinbase this morning in the Southern District of New York for failing to register its trading platform with the agency, alleging that it was an unregistered national securities exchange, broker, and clearing agency. The SEC also bringing charges against the largest U.S. crypto trading platform for failing to register its crypto asset staking as a service program.
25,000, which is actually a little bit below here, was a floor. That's a big historical area for Bitcoin. It is not yet reclaimed yesterday's high. And so this is factoring also the news we got yesterday from Binance.
Coinbase was involved in staking in general without registering a staking platform with the SEC. In the eyes of the SEC, staking, the action through which proof-of-stake tokens are created, is in itself a means through which securities are created and exchanged. And that really is one of the big questions now with regard to Coinbase is, will it be able to pivot overseas? In the first quarter, the US represented about 86% of Coinbase's net revenue. That is not an easy pivot to execute.
I think the questions out there is what are actually securities and not securities, and do SEC actually creates a pathway and say this is how it should work?
The agency said it's acting as a broker, an exchange, a clearing agency, and also a seller of securities. They say as a result, Coinbase is then evading disclosure laws that were specifically set up to protect consumers by Congress. This is the 14th case that the SEC has brought against crypto entities since January.
Bottom line here is if the SEC doesn't completely shut down Binance and Coinbase, probably not going to derail crypto, but if in fact the Coinbase business model cannot survive with SEC regulation, well, that's a different story altogether.
Well, the stunning announcement that the Saudi-backed Live Golf tournament was merging with the PGA has raised many questions surrounding the politics at play. It's not the first time Saudi's public investment fund has poured money into international sport and business as the kingdom looks to diversify its economy beyond oil. Here to discuss more is Hussein Ibish, senior resident scholar at the Arab Gulf States Institute in Washington. Hussein, good to talk to you today. You know, we know the Saudis have been looking to place their bets beyond oil for many years now. The private investment fund, we're talking about $650 billion in assets under management with the goal of hitting $1 trillion in a few years. How does the announcement yesterday fit into the grander vision?
Well, it fits in perfectly in two different ways. First of all, the Saudis are looking to diversify in every possible way. They know that, they're tardy to come to the diversification sweepstakes. They have a big population. Most of the oil exporting countries in the Gulf are city-states. They're small, but there are at least 30 million Saudi citizens. And, there are poor people today in Saudi Arabia. So, they're facing a bleak future if they don't create a post-hydrocarbon economy. They decided a couple of years ago that they want tourism and entertainment to be the number 2 industry in the country. And this is a radical transformation for a country that didn't want tourism, didn't allow entertainment for decades. But they're really building up their tremendous historical sites that are, sort of some of the earliest civilizations known to man. These beautiful natural resources that they're promoting and spreading into other entertainments like sports, like racing and cultural festivals, concerts, things unthinkable in the past. Now, this PGA merger, it fits perfectly because it's designed not only to diversify Saudi Arabia's economic holdings, but also to help its image internationally. And that's also important to Saudi Arabia.
How much do you think it really is helping their image internationally? And many are viewing this, actually, that the Saudis did win this, like you are saying, that this deal makes a heck of a lot of sense for them, that they are in a better position at this point. So what does this tell us just about what those future moves from the Saudis, what that could potentially look like?
Well, I mean, Saudi Arabia put itself in a real hole. The Saudi government put the country in a real hole through several actions, through the intervention in Yemen, which was mishandled, and there was a lot of death and destruction in Yemen. Well, much of it wasn't Saudi Arabia's fault, but the Yemeni rebels don't have an international address, and the Saudis do. So they ended up taking the blame for the whole Yemen war, which really is a catastrophe. Then there was the murder of Jamal Khashoggi, the Saudi journalist in Istanbul, in the consulate in Istanbul, which was a ghastly atrocity, and human rights abuses that rightly get attention and condemnation. So there is a negative public image of Saudi Arabia, and it gloms onto earlier things like the oil embargo in 1973, 9/11 that was largely carried out by dissident anti-government Saudis, but still Saudis. So, there's a lot of baggage in the West and especially in the United States. Mm-hmm. So I think there is this idea that as Saudi Arabia becomes associated more with things like movies and golf and, Formula One racing and concerts and tourism and culture and art, that could offset a lot of the negative impression that people have of Saudi Arabia. That it is based in fact, but it's unfair because it doesn't take into consideration the reforms that have been going on that really are dramatic and impressive.
Hussein, I'm thinking back to when we had MBS essentially sort of lay out this vision of diversification beyond oil. Vision 2030 was supposed to be about this pivot to big tech. Yes, they have placed significant investments, but they haven't necessarily got investments into the kingdom with companies wanting to establish themselves there.
That's right.
Does that mean, or has that accelerated these types of investments, essentially buying influence abroad?
That's the crucial question for Saudi Arabia, because on the one hand, they've been successful in diversifying their own portfolio, right? And this is another example of that. And it's not a problem for them if they want to take their money and spend it on something. They can do that, and they can make money that way, and that's good insofar as it goes. But what they want, and this was on big display in the large financial conference they had in Riyadh last year, where all the titans of American finance basically showed up. The government didn't, the Biden administration didn't, but the financial community came. But the Saudis were successful in making their own investments, but they haven't got a steady stream of foreign direct investment into Saudi Arabia. One of the biggest things holding investors back, especially large institutional investors, is the lack of transparency and the lack of rule of law in Saudi Arabia. They're making baby steps to this, but investors want to know what kind of rules are going to protect their money. If they get into a dispute with a prominent Saudi or something connected to the Saudi government and they try to sue to recover, what chances are there, they want to know, that they'll be treated fairly in a Saudi court? Where is the transparency? Where is the independent judiciary that could rule in favor of a foreign investor as opposed to a very powerful Saudi or even the government itself? That's a real question. And the Saudis haven't gone far enough in creating mechanisms that reassure foreign investors that their investments are protected and that they have predictable rules, that if they play by those rules, they will be treated fairly. And that it's not like there's a big track record of people being ripped off. It's just that when you're talking about amounts of that size, people really do want to know that there's a fair system behind it.
Hussein, to what extent are global regulators likely to stand in the way of that vision they want to build out domestically? You look at what's happening here in the U.S., for example, there's already talk of potentially somebody like a group like CFIUS stepping in. May not happen in this case with LIV and PGA because it is sports and the concern seems to be more about data collection, but it does make regulators a little uneasy.
Yeah, it does. And that's something the Saudis are going to have to deal with, without a doubt. In some cases, the regulators are going to have very valid concerns. And at that point, again, it's up to the Saudis to demonstrate that that those concerns are not valid, and to get the investments, whether they're investing or someone's investing into them, or it's joint, as in this case, then, it really is something where they have to prove that, to these regulators and even sometimes multinational or multilateral organizations, that they're trustworthy and that it's okay. And, they will feel harassed and put upon by that. But in fact, that's what everybody has to go through. You've got to demonstrate trustworthiness. You've got to show your bona fides in these international markets. Otherwise, investors will hold back, regulators will make objections, and it won't work. So I think they know that. It's just a very heavy lift, and they're transforming so rapidly that you can't do everything all at once. And that's another of their big problems, is they're trying to go incredibly far, incredibly fast. I don't think we've seen this kind of change in any country since Japan in the Meiji era, in the late 19th century. That's probably the best analog to the pace of change in Saudi Arabia today.
Well, we have certainly seen a lot of change over in Saudi Arabia as well. It'll be interesting to see how this all plays out here in the U.S. too. Hussein Abish, Senior Resident Scholar at the Arab Gulf States Institute in Washington. Appreciate your time today.
Thank you so much.
One Amazon analyst making a big call. Bernstein's Mark Shmulik wants Amazon to simplify because the tech giant is, quote, pursuing too many ideas. He wrote in a new open letter to CEO Andy Jassy and the company's board, quote, there's a significant amount of self-help Amazon can take to quell investor concerns around the current investment strategy and investor communications, and together could propel the stock into the $180 to $200 a share range. Joining us now is that analyst. We want to bring in Mark Shmulik, Bernstein Internet Research Analyst. Mark, it's good to see you here. So in this note here, you also highlight it's time to refocus capital, time to retake the narrative. How do you think Amazon should go about doing that?
First off, great to be on the show. And I think, this note follows what we've done last week, which is we've upgraded Amazon to our best idea in the internet space, irregardless of what we proposed here, primarily because we don't think the narrative matches truly improving fundamentals in the core business. But if we really want to take the next step, I've certainly sat in on many investor conversations that felt more like therapy sessions than they did, analyst conversations. Effectively hearing investors question specific investment decisions, lack of disclosures, and lack of clarity. And, what I was hoping to do with this note is really perhaps highlight some of perhaps the biggest areas of investment that I certainly have questions around. Wonder if we could at least see, separate disclosures of things like Project Kuiper, putting, low orbit satellites up there with internet access, things like their healthcare services, moving them aside so we could truly see the successful performance of the core business. And secondly, reevaluate some of those investments so that Amazon could really, redeploy capital on some initiatives we think only Amazon can do, those being buy with Prime in their media business.
I mean, couldn't you argue that Amazon's already started to slim things down a bit when you think about where they have targeted their most recent layoffs, though?
Yeah, absolutely they have. And I think just last week there was the report that they, have trimmed down or kind of wound down 37 different projects. So they're clearly in that mindset already of looking to kind of rationalize and optimize. I think that much is clear. I'd argue that some of the things we've proposed in the letter are perhaps a little bit bigger. If you look at some of those initiatives that they've wound down, it's things like, a video device for kids. I don't know if that's really going to move the needle in terms of, finding incremental capital. What we're talking about is really evaluating entire international markets. Do they need to be in a place like Brazil where they've been losing share for the last 3 years and, they're not the number 1 or 2 player? They should be rethinking what they're doing with their physical grocery rollout where, they have shared that they haven't yet found that perfect format, and yet they build out about 44 of these Amazon Fresh stores. So I think the level of ideas that we're proposing here, are certainly large-scale investments that could really move the needle if there were any change in kind of current operations.
Mark, one of the initiatives they are pushing is to focus on Amazon Media, like you said, into what you say is the next great media property. There was a story in the Journal today that Prime is potentially looking to adding a ad tier as part of their service. What else do you think Amazon could be doing in this space that they're not?
Yeah, no, I was very glad to see that report this morning because it at least aligned with an area where we thought, was due for incremental investment. And the reason for that is, if you think about the future of media consumption, I think Jim Barksdale famously said, there's 2 ways to make money, bundling and unbundling. And I think what we're seeing is a rebundling of kind of video consumption. And they've got the full stack. They've got the TVs, they've got the Fire Sticks, they've got the content, they've got the Prime channel, they've got Freevee. They own content rights from live sports, etc. And so they've effectively got this full stack to be able to offer consolidated media services, monetize it via subscription ad advertising dollars, and expand even off property. One deal or announcement that we'd highlight, is they recently entered into a partnership with Pinterest, which we think is one of those things that probably only Amazon and a few others could do, bringing their first party data to the table for their advertising base and effectively being able to fill ad inventory off of Amazon. So we're very optimistic on the progress being made on that side of the house.
What about the play for healthcare? I mean, that's one thing that you've highlighted. They haven't had much success before, but you could argue that they are sort of in a position to pursue it given where competitors stand. What do you think they should be doing?
Yeah, I think the issue I take, or perhaps the confusion, is just around even the term healthcare just feels too broad, right? It's an entire industry to go after. But the reality is that there are probably some very viable businesses Amazon should be in underneath the healthcare umbrella. It's just unclear at the moment what those necessarily are. Certainly, we've seen it through the PillPack acquisition and the expansion of Amazon Pharmacy. But they've dabbled a bit in insurance. They've dabbled a bit in telehealth. They've bought One Medical. It feels like there's just a lot going on at the moment, and it's unclear, really what's going to stick there and what the real true opportunity is. Because, in addition to them pursuing this, we've heard a kind of a string of announcements of them winding things down, or the dissolvement of Haven, or the shutting down of the telehealth services recently. So to me, that just feels too broad at the moment and unclear where all those resources are going and what the real opportunity is that only Amazon can do.
Well, Mark, despite all of these, broader concerns that you do have for Amazon and the vision here going forward, you still have an outperform rating on the stock, $140 price target. What do you see as the catalyst here for Amazon then in the near term?
Yeah, no, it's not only an outperform rating, it's our top pick. This is kind of gravy on top of that of how do we break out beyond kind of my price target into the $180, $200 range? How do you get to being a $200 stock? And the reason why we're outperforming and have it as our best idea is we think that the current narrative just doesn't match up with improving fundamentals. We saw this last quarter already where the retail business, especially domestically, is really making inroads into, accelerated profitability. They're profitable again, and that's not going to stop. They're going to keep growing domestic profitability for retail. And on an AWS, which seems to be driving a lot of the stock, movement at the moment, folks are waiting for it to bottom and wondering, is Amazon in last place in AI? Look, that's a narrative at the moment. I don't think there's much substance behind that narrative. But in order to quiet down that narrative, you need to see improving fundamentals. Whether it's this quarter or next, we're getting close to that point when AWS growth estimates are going to bottom. Once they bottom and reaccelerate, I fully expect the narrative to catch up, with a really compelling fundamental story that we see before us.
All right, Mark Schmelik, you laid out a compelling case. I'll give you that. Thanks so much for joining us here. We appreciate having you on. Talk to you soon.
Thanks for having me.
All right, coming up, we check in on the latest return to office trends. The Chief Revenue Officer of WeWork joins us after the break.
Well, we've heard repeatedly about the commercial real estate market being under strain from waning demand for office space, largely because of the move to hybrid and remote work. But our next guest says that's not exactly the case. Here to dissect the emerging trends shifting the commercial real estate landscape is WeWork Chief Revenue Officer Ben Samuels. Ben, good to have you on today. It's interesting to hear WeWork's perspective on what has been playing out, because we've heard from sort of large real estate companies that have said, look, we're just not getting these office spaces rented out. You say a lot of those companies are coming to you.
Firstly, thanks for having me. It's great to be here. We've really seen an incredible trend on the return to office. I sit in London, and I've had the good global perspective for a few years now. Post-COVID in international, we saw people come back to the office straight away. As soon as lockdown and restrictions were lifted, people started coming back, and our footfall and our traffic and the return to office was really robust. I think the US was a bit more of a mixed message. I think that the return to office wasn't quite as clear, and it was a bit of a slow burn. But now, we've really turned a corner. I think it started in Q4 with some of the more traditional occupiers, banks, financial services. Their CEOs came out and said, we need people back. But it really wasn't until the end of Q1, early Q2, where we saw the tech companies and even leading AI companies saying, we need to be in the office. We're better together in the office. And I think that's driven some of the urgency that we've seen. So there's been a real scramble for space in many of our markets.
Ben, has that started to level off at all? Because when you take a look at a lot of the data, we've been hovering around 50% now for the last quarter or so. So I guess where do you see that growth then coming from in the future?
Well, I think, as I said, you saw that the first wave really hit, I'd say the end of last year, early this year, but it was only a handful of occupiers who were really mandating that return to office, and very prescriptive to return to office 3-4 days a week, perhaps. But I think it's only recently where we've seen the tech companies turn that corner. And I think they've been very prescriptive of what their expectations are. It's been controversial, but I think they're heading clearly in one direction. So I think while you did see that initial wave kind of plateau, I think when we look forward to end of Q2, Q3, you're going to see a step up in that. Certainly from our perspective, the large companies that are coming to us, we not only need a lot of space, we actually need it for return to office immediately. Some of them are taking space in May for a June move-in, but certainly as they look post the 4th of July, Labor Day, the expectation is a lot of people will be back in the office. And I think it's fascinating if you look at the employee base of some of the largest tech companies, the headlines have captured everyone's imagination about layoffs, but in reality, they have way more employees today than they did pre-COVID. So you're in a situation where you have many employees who are working remotely. Now they've also spent time getting rid of office space, downsizing. Now you have a real scramble for space where you have more employees, less office space, and you want to create that good experience at the office. You need more space, and you need it now. In fact, we were on a call with one of the heads of real estate from a leading tech company who said in Europe in particular, they're having some people have to sit on the floor. So that's not going to be a very good return to office policy if people are sitting on the floor. So I think there's a real need for space, and a need for space urgently.
Yeah, and that speaks to the sheer scale of the ramp up that we saw, especially within tech during the pandemic. I wonder if you can take me inside some of these conversations you're having with these big companies, because I'd imagine on the one hand, publicly they're saying, well, we want employees to come back to the office. And yet behind the scenes, they've got to be thinking about what the future of the office looks like. They're going to WeWork because they want more flexible terms.
Absolutely. I think it speaks to our value prop. Where you're going to be able to get 10, 20 or 50,000 square feet with turnkey solutions. So that's fully fitted, ready to move into on Monday. There just aren't a lot of places. So as you're doing your trial and error, as you're working through what the return to office looks like for you, flexibility is really critical. I think, when you thread the needle on on traditional real estate on a 10-year lease, you need to be very, very clear about your headcount, your utilization, and your term. But what we offer, space as a service on flexible terms, means you can start. See how it goes. You can take more space. You can take less space in the future if you need it. You can also port that space from one city to another city. So we've really tried to create liquidity in what has traditionally been a very illiquid space. You could hire a team in Seattle and say, you know what, they really need to be in Austin. And with us, we let you to make those pivots. So it's really leveraging our portfolio of 800 locations globally to work on your RTO, to trial and error and partner with us, hopefully, to get it right. And there won't be one model that'll be successful going forward. Every company is going to have something slightly different. We think we've evolved post-COVID into offering multiple solutions. So of course, as the traditional space as a service, our office on flexible terms. But then there's the all access product for those who are going to continue to work remotely or flexibly and need to tap into an office space or a conference room on demand. And then there's our workplace, WeWork Workplace, which we rolled out. It's sort of our super app and platform to manage that return to office. Nothing is worse than showing up in the office and then realizing the rest of your team wasn't there and you're on video calls all day long. So it's not only about collaboration in the office, but intentional collaboration. When you come in, it has to be meaningful. So I think marrying those three legs of the stool together is really helping us partner with some of the largest occupiers on figuring out what the RTO looks like.
Yeah, Ben, we're in the office 5 days a week, and I got to say, I was a little hesitant at first, but there are a lot of pros to being in the office here. But when it comes to the investor side of the story, there's been a lot of focus on WeWork, on the cash burn rates. What does that look like? Has that stabilized?
Well, I think if you go back to Q1 and what we announced, we announced a couple of things. Number one, our debt restructuring, which we're really proud of. I think it's pushed that debt wall, if you will, out, several years, giving us plenty of runway to execute on the plan. I think we were very clear on Q1 and through that debt restructuring what the plan is, what our milestones will be, what our goals are. And this team here has never been more focused on delivering on that. So we feel comfortable that we have plenty of runway. We've raised more cash. We've converted some debt to equity and given ourselves a lot of headroom to deliver in what we think is really our market. And we think now is the perfect market for a company like WeWork, given our scale, given our size, and given that the market is really moving our way. I think it's not only a short-term scramble for space with WeWork. I think there's a structural shift going on, and we're very well positioned for it.
Well, Ben Samuels, we hope to have you back on the show again soon. WeWork Chief Revenue Officer, joining us from London today.
Great, thank you.
Despite the AI hype raising investor interest in tech, it wasn't enough to change the muted landscape in global venture funding. For more on those details, we have Yahoo Finance's Ali Garfinkel. Ali, what are we seeing?
Hi, Shauna. So AI has been hot, and that's been true in the public markets, and that has been true in the private markets to an extent. Now, what do I mean by that? So let's look at May. In May, we saw a couple of AI startups really raise some substantial rounds. Those included startups like Lightmatter and Anthropic. And we also even saw two new AI unicorns. One is called Cohere, which is a ChatGPT competitor, and the other is called Runway, which is a generative AI video platform. However, these hyped AI investments are actually only accounting for 13% of funding. Now, the broader data that it was showing was actually quite a bit gloomier. The global VC funding landscape came out to, in May, $22 billion, which sounds like a lot, but actually that's a 44% year-over-year decline. Shauna, Kiko, to me, the bottom line here is that macro funding climate still is really rough. And to me, that also bespeaks the fact that AI, as much as we talk about it, as much hype as there is, it's still pretty anomalous, not only in tech, but in the broader landscape.
We're going to put all that in context. Ali Garfinkel, thanks. Well, coming up, the International Council of Shopping Centers is forecasting steady growth within the sector. We'll check in on the state of the retail consumer with the agency's association's CEO when we come back.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Despite a mixed earnings season for many retailers, the International Council of Shopping Centers forecasting steady growth within the sector, with more than 90% of shopping mall real estate occupied. The marketplace industry seeing openings outpacing closures. Here to tell us a little bit more about that is IXIC's CEO, Tom McGee. Tom, it's great to have you here on set. So just give us a better perspective about what you're seeing within your sector of commercial real estate and how much that trend has changed, if at all.
Well, suburban, obviously with the work from home, the demand for suburban retail space, particularly in the open air, grocery anchored shopping center or a Walmart, Target anchored shopping center, is exceptionally strong. It's the strongest that I've seen it in my time. The use of physical space has evolved, and so retailers are using it, yes, for traditional shopping, but also to fulfill online orders, whether that's click and collect, people coming into the store to pick it up, or shipping from stores. And so the demand for space, and the vast majority of retail real estate space is in the suburbs. And so with people working from home, they also have more time to shop. And so that's been exceptionally positive for the industry. Central business districts are more challenged because of the challenges in the office space. That's a small part of the industry, a small part of the square footage, but it's a visible part when those retail establishments or restaurants that are dependent upon office traffic are more challenged.
Yeah, let's talk a bit more about that, because we've heard over and over, especially in central business districts, the expectation is that some of these spaces just won't be filled by previous tenants or the standard office in the company. What are some of the creative ways we're starting to see sort of retail space taking shape right now?
Well, that issue is more office-centric than retail-centric. I think the challenge for retail there is that there's a number of retail establishments that were established to serve a office population of a certain amount. And if you're only having, folks going to the office 3 days a week or 2 days a week or 50%, you're not going to need as much retail, you're not going to need as much restaurant. The broader office opportunity that's been talked about is conversion of that space into, multifamily or other uses. That's complicated. You can, walk around New York and just imagine, the challenge around a conversion of significant office space into multifamily. I think the hope and the expectation would be that over time, you'll see some transition to a more steady state of people coming back into the office.
There is some, though, mixed use, though, that we are seeing more so come up within shopping centers, even within suburban areas, too, right? What does the foot traffic look like at those shopping centers compared to those that have not been converted to mixed use yet?
Yeah, I couldn't give you a specific, comparison between the two, but mixed use, well-built mixed use with a good mix of retail. Retail really brings the life to that mixed use community. It's the glue of it. And then residential or other or hospitality. Obviously office, because suburban office isn't as challenged as the central business district office. Is super popular. People like that live, work, play concept, and that's super positive for the retail in that too, because you have a captive group of customers, right? So again, I think the whole retail space, the consumer's been resilient. You mentioned that we believe this will be a solid retail sales year. I mean, you have inflation of 4.5%, 5%. That's kind of where we expect sales to land, retail sales growth this year. Consumers been resilient. They are, obviously sensitive to inflation, but so far they've been willing to continue to spend. You are seeing consumers becoming increasingly price conscious, and so you're seeing a move towards more discounts or off-brand products, but they're still spending.
I'm thinking back to what the conversation was around retail pre-pandemic. So much of it was about the experience. Mm-hmm. And I wonder to what extent that has shifted. Maybe you're just talking about more and more people shopping online, shopping from home. If we're talking about the suburbs, has that shifted the entire usage of retail space?
I still think experience is super important. I mean, there was concern around, the focus upon experience when you're in the middle of a pandemic, obviously, because that, creates crowds and so forth. I think that we've moved beyond that, and I think having curating a mix of good retail space that provides products as well as services is still really important. And we recently did a survey of Gen Zs, which we focused upon folks between the ages of 16 and 26. And it was fascinating just to learn a whole host of things around that generation that I think is quite positive, holistically. But one of them is they really value, going to physical stores and having that experience. It's the digitally native, obviously, generation. They clearly shop online. They clearly use social media. But perhaps because they're so immersed in that, they really value, that experience of going to the store as well. I'm super bullish on that generation. I think it's a real positive. Our findings, which I think are consistent with my experience, I have 2 Gen Z kids, very hardworking, career-driven, financially responsible. They grew up in the shadow of the financial crisis as well as the pandemic. And so I think that lends well for the future of the U.S. economy, but also for the future of retail. I mean, they're very pragmatic and responsible.
Yeah, and to that point there, Tom, I guess in terms of the brands that they are favoring, what's the common thread among that, and how do you think that then shapes really how brands evolve and develop from here?
Well, clearly that generation, probably even more than even the millennials, they want to shop with brands that are consistent with their values, socially conscious brands. They're very focused upon price consciousness, and part of that's the age. I think for a brand to build credibility and a relationship, they need to have a social media presence, and quite frankly, be on TikTok and Instagram and so forth, beyond just traditional digital mediums. But what's interesting about that generation is that despite how focused they are upon the use of social media, they're still, the biggest influence in their life is still their family and friends in regards to, where they shop, what they buy, what brands they're loyal to, and so forth. So that timeless nature of just having relationships and leaning on the people you trust is not dissimilar in that generation as any generation.
That's very reassuring to hear, because as having little kids, I get a little worried about how much time some of the kids are spending on technology these days. So Tom McGee, ICSC CEO, thanks so much for joining us here.
Thank you.
All right, well, coming up, we will get you set with the closing bell on Wall Street, the final minutes of the trading day. The Dow's still up just 91 points. We'll be right back.
A bit of a split picture here as we hear the closing bell on this Wednesday afternoon. We've got the Dow in the green, the only one here up about 97 points there. The S&P 500 down 16 and the Nasdaq down 171.
All right, let's take a look at some of those individual stories today. Stock movers. First up, Netflix closing the day in the green by just a bit, up just about 0.1%, following some upgrades here from the street. JP Morgan raising its price target on the stock to $470 a share from $380. The analyst there saying that the streamer's paid sharing program is going to boost revenue over the next few years. Wells Fargo also raising their target to $500 from $400. Akiko, when it comes to the JP Morgan note, they were very bullish just on those 100 million borrowers globally that Netflix estimates that they have. JP Morgan thinks that they're going to be able to convert 14 million of them into paid subscribers by the end of the year.
Yeah, and part of the note also looks at some of these markets that they were testing this in, saying that there was less churn than expected, right? That was kind of the concern about, especially with paid sharing here, how many would actually opt out of that. Now, given what they saw in those 4 markets, JP Morgan saying essentially they think there will be less of a recovery time when you compare it to some of those other markets as well. So these revenue drivers, certainly what has been behind those bullish notes on Netflix, and the fact that users are still sticking around, probably certainly a positive sign.
Yeah, certainly would be a positive sign for the bottom line.
Affirm shares higher today on news. Amazon will let U.S. retailers that already use Amazon Pay to offer Affirm's buy now, pay later services. Amazon customers have already had access to Affirm, but adding the adaptive checkout service to Amazon Pay allows for easier access to the pay later feature. And we saw a big move for Affirm on the back of that. For those who aren't necessarily familiar with Amazon Pay, it essentially allows you to use it on third-party platforms with all the information already stored on Amazon, and that's on Amazon, and that could certainly be a big boost for Affirm. Some would argue that they have started to lose ground here a bit since Apple got into the buy now, pay later space.
Yeah, that has been a huge concern for Affirm, for some of the other competitors within the space out there. In terms of what this means for Amazon, Truist was out with a buy rating on this stock here. And also when it comes to Affirm, they're saying that this is a, quote, digital wallet shot in the arm, talking about now it's going to give Affirm a little bit of an edge when you compare it to some of those competitors out there, given the fact that Apple has entered the space. It certainly has been a massive concern for many of the other buy now, pay later offerings out there on the street. All right, let's take a look at Tesla shares riding higher as investors' bullishness grows. This coming after the news that the Model 3 vehicles now qualify for full U.S. tax credit. Tesla shares up over 80% since the start of the year, despite some of those recent declines as the company rebounds from last year's massive 65% plunge. For more on this and what we could see from Tesla ahead, let's bring in Canaccord Genuity Managing Director George Giannarakis. Sorry, George. Struggling with your name there. Apologies for that. But, George, let's get into your thesis.
Pretty good.
Here. Was it okay? How do I say it?
Yeah, it's pretty good. It's pretty good.
All right, we're going to nail it by the time that it comes to the bank here, George. But let's get into the call here on Tesla, because you're bullish just in terms of what these tax credits, what it could do for demand. How big of a bump do you think we could potentially see?
Look, over the last, call it 5-6 months, Tesla has seen some demand issues. They started cutting prices late last year. They enacted 6 price cuts until recently, where they seem to have stabilized that a little with some marginal price increases recently. And this is happening globally, whether it's the US, Europe, China. We've seen general demand weakness in auto and in EVs and in Tesla specifically. It showed up not so much in their unit numbers last quarter, but in their margins, right? The margins dipped below this magic sort of 20% on the growth side that they had talked about and guided to. What this tax credit does is it helps not only stabilize demand, but potentially increase it over the course of the year. They've guided for 1.8 million vehicles. And I think that most people expect them to sort of kind of hit that. But where it could help them quite a bit is in their margins, because they could get to this target without having to cut prices further, because frankly, the federal government is helping them do that. And if you think about what it costs to buy a Model 3 in the United States, they're getting a $7,500 tax credit if you meet certain income requirements, which makes these comparable in some states that offer additional tax credits to a Toyota Camry. So really, the Model 3 with multiple tax credits is becoming a mass market vehicle, which is just an incredible thing to see. It around $25,000 if you live in states like California or even Colorado.
Yeah, you know, George, I was adding up those tax credits today as somebody who lives in California. It is a huge, huge discount when you think about it. But Tesla's not the only car maker, at least in the EV space, that is getting that kind of sort of double credit, right? The federal tax credit as well as whatever the states are offering. How do you think Tesla competes in that environment when things are becoming increasingly crowded in the space?
Look, Tesla has a lead in EVs, a very strong lead, particularly on the mass market side, and they can make money at those price levels. I mean, look, we cover a company called Rivian that's a competitor, but they have a niche product, a very, very good product with a high-end SUV and truck. Those don't qualify for these tax credits, but this is a completely different marketplace. And the GMs, the Fords, we don't cover them, but at this particular price point, it becomes very hard for them to make money in this $20,000 to $30,000 range for EVs. Tesla can do it. And it's really their ability to have full vertical integration that's allowed them to do that. They make battery cells. They even mine and process materials. They have this autonomous driving software called FSD that can add to margins. I mean, the way we think about their business, it's razor blade, meaning that they sell these vehicles at a 20-ish% gross margin, and they hope to penetrate and get additional high gross margin software sales over time through adding on full self-driving. Now, right now, it's priced at $15,000 for that option. We think it's very, very compelling, but it's getting a lot more expensive, particularly relative to the price of the car that seems to be going down in price, either through Tesla's works or through federal tax credits. So we're advocating for a price cut for FSD from $15,000 maybe to the $10,000 range. But that really helps their margins over the long term.
George, when it talks about the potential here of FSD, there was talk earlier this week, Elon Musk saying that he would be open to licensing the technology. Of course, there was also the partnership with Ford last week for its charging network. Do you think that's a smart move here going forward for Tesla, just in terms of licensing some of the technology that they have already perfected at this point?
Look, it could be. We'll have to figure out how that works and what kind of price they offer. We actually initiated today on 2 companies in autonomous driving. We called our report AI for the streets, because ultimately these are AI companies, right? Not only is Tesla an AI company, but a company like Mobileye, who initiated on, or Aurora. These are really, really interesting stories that create a product that has a lot of AI embedded in it. So if companies really want to move forward and have strong autonomous offerings, they have a couple options. And on the passenger side, right, today, they could potentially do something with Tesla. We'll see how that works out. They could also use something from Mobileye, and over the long term, maybe even something from Aurora. So they'll have multiple options. But on the passenger vehicle side specifically, we think Tesla is in a very, very strong position, as is Mobileye.
You know, you talk about the vertical integration that has really been key to Tesla's success. And, you know, I'm thinking too, as a driver, you know, the benefit of having something like a Tesla is the infrastructure that is already in place for those Tesla drivers. As we see more and more offerings within the EV space, you know, how much of that becomes a real advantage to Tesla? I mean, it already has been, but now that we're talking about affordability for the car, To what extent does that become an additional lever, additional reason for drivers to say, look, this is why I'm going with Tesla?
That's a great question. So what we've seen so far is that through vertical integration, Tesla has been able to offer vehicles at a low price and still make money on them. What we'll see in the future, and what we're seeing from a company like Rivian, for example, is that what vertical integration does is it allows features to be downloaded over the air. And it sounds like it's easy, right? We all have it on our smartphones, for example. But in order to enable real over-the-air features, like something Rivian offers called camp mode, where it literally changes the suspension of your vehicle, you have to be able to write software at a system level. You have to be able to write the braking software, the motor software, and all this stuff that today a company like Ford, for example, buys from hundreds of independent vendors. As a matter of fact, there was a recent interview with Ford's CEO where he described this very phenomenon. So these companies have to be built up from the ground and have to embed a Silicon Valley, a software type infrastructure and culture that's really hard to do when you're re-engineering your company. And companies like Tesla and even like Rivian have done that from the ground up. They started with a clean sheet of paper. And so that kind of that DNA allows you not only to have low prices, but also really great feature sets.
So does Rivian present the biggest threat to Tesla? I mean, clearly we've established that you're very bullish on Tesla. What is that one car maker that you think could really offer or could present the biggest threat?
I think we don't cover them, okay, but I think that over the long term, and we've written this in our reports, the market will be Tesla and maybe a couple other OEMs on the traditional side. We think Rivian has a very, very good chance. But it's the Chinese OEMs that present a global threat to Tesla's dominance. And it's the same way the smartphone market has worked out. We have Apple, and we have a lot of very successful Chinese vendors. So, and maybe Samsung too. And that we see the EV market really structuring itself long-term in a very similar fashion to the smartphone market.
Yeah, it's a good analogy right there. George Gianarikas, Canaccord Genuity Managing Director. It's good to have you on today. Appreciate the time.
Thanks for having me.
Coming up, our weekly ETF report, and we are talking how to invest in AI amid all of the hype. Stick around.
GameStop disclosing that its board of directors has elected Ryan Cohen as executive chairman effective immediately. This comes as the company announces a termination of its former CEO. You're looking at shares off just about 7%.
Well, U.S. markets posting strong gains so far this year, but we've seen even larger gains in markets around the world. Recent data shows that inflows are moving into international stocks. And our next guest says it pays to be diversified. Joining us now is VettaFi financial futurist Dave Nadig for this week's ETF report brought to you by Invesco QQQ. International markets, one that we've been hearing a lot, but we're talking about a number of different markets, EMs, Europe, as well as Japan. Where are you seeing the inflows?
Well, the inflows for this year so far have been pretty strongly in international equities, which has been a big surprise. Historically, the U.S. runs about a 70% home bias, so every $10 that goes in, you'd expect about $7 to be U.S. equities. It's kind of been the opposite this year. We've had about 34 billion into international equity, 20 and change into U.S. equity. A lot of that focus has been on Europe. A lot of the managers I've talked to have seen Europe as the place to look for the rest of 2023 and next year for growth. Some of that's just diversification, not just of types of companies, but regulatory regimes. Things are really bifurcating between the US and the rest of the world in a couple of areas. AI, crypto regulation, even core financial regulation. There are now really significant differences. Those regulatory differences can create opportunities. So we've seen Europe outperforming the S&P by about 5 or 6% year to date so far on a hedged basis. And I think that's an important thing there. Hedging an exposure like Europe or Japan can make a lot of sense when we have a lot of central bank activity still happening.
So Dave, talk to us about some ways more specifically that investors can play this in terms of the funds that would give them exposure then to that play.
Sure. So one we see a lot of is the Wisdom Tree Hedged Europe, which is HEDJ, I recall. It's up about 16-17% so far this year. And basically it just buys a basket of stocks denominated in the euro and then hedges out all that euro exposure. So you're not stuck in this game of trying to make a bet both on whether or not a company is a good company or a country is a good country, but also whether or not the central bank policies between them and the US are going to line up in a way that's particularly favorable to have shorted the dollar and bought the euros in the first place. So I think it's a good time for folks to relook at that international exposure and consider that currency impact.
Yeah, the regulatory bifurcation is an interesting point because we have started to see that. One area where regulation has not fully taken shape yet is AI, one we'd like to talk about a lot. I mean, there's so many different plays that we've heard from analysts we've had on the show, but how do you look at it from a passive investing perspective?
Well, there are index-based products that you can look at to approach there at VettaFi, where we run an index behind the Robo ETF, ROBO. The biggest player in the space would be BOTZ, B-O-T-Z from Global X. And those kinds of passive approaches can make a lot of sense when there's still a lot of moving parts on the field. We've seen more performance out of those types of products than we have out of some of the sort of ARC type products, the more innovation, equity, active management strategies. They certainly have looked at AI, but we haven't seen the kind of deep wading in that we've seen. Things like BOTZ. BOTZ is up over 40% this year by itself, largely because it was so heavily invested in NVIDIA, and we remember what that earnings report looked like the other week, right? So those kinds of plays can really help. I should caution, though, that those are very concentrated bets. Anytime you're looking at a theme, you should think about this as a speculation, not as a core holding, because these stocks are going to move with the hype cycle and the headlines.
So then the flip side of it would be you're also, I would guess, maybe then recommending some exposure to AI through some of those larger tech giants like a Microsoft, like a Google that have an AI play, but clearly much more diversified than those pure plays.
The question is, we already own those things, right? I mean, if you own the Qs, if you own the S&P 500, you already have big exposure to most of the companies that are investable. The problem is a lot of the interesting work is being done either in non-public companies like OpenAI behind ChatGPT or in small startups that we obviously can't get access to yet. So because it's still such early days, there's this weird bifurcation where the things you can buy may be a little too diluted to be considered a real play on the space. You can't buy the things that would be a pure play. I think the smarter move is to look at the industries and companies that are going to be most impacted by AI. That's things like healthcare, transportation, logistics, factory, retail. We've already seen massive benefits there from robotics and AI. That's going to be, I think, where you're going to continue to see that growth.
We've heard sort of so many guests talk about the picks and shovels when we talk about AI. Yeah. I mean, what about that? Just sort of the foundational plays, whether it is NVIDIA or just other semiconductor names. Is that a good way to sort of bet on the future of AI?
I think that's a good way to bet on the future, period, right? I mean, I think AI is going to be a sub-theme of a bit of a tech bubble we're going to run into here. AI is going to enhance productivity. It's going to increase margins in those tech companies, yes, but also in the companies that they serve. So think about your tech exposure in general. Think about where that's got the focus. And if you want to load up a little bit in some of the automation and AI plays that are real world and maybe even a little more industrial than tech, that's where a product like Bots or Robo is going to work for you.
Okay. Dave Noddick, always good to get your takes. Appreciate your time.
Thanks for having me.
Well, coming up, CNN CEO is out, leaving the network after a short and controversial run at the top. We're going to discuss that and other top stories on the other side.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Let's take a look at some of the top trending stories of the day with Ali Canal and Josh Schaefer, our regulars here around the round table. All right, we are starting with CNN's CEO out. Chris Licht leaving the network after a short run at the top. And Ali, this is one that I know you've been following. I mean, really, it is about all the changes that have happened at Warner Brothers Discovery. But after that Atlantic piece that came out, feels like the writing was on the wall.
Yeah, to me, that was the nail in the coffin to this story. Of course, Chris Licht, it was riddled in controversy. He took over shortly after the demise of CNN Plus, which was CNN's failed foray into the streaming wars. There's been mass layoffs. Of course, that Atlantic article really documented all of his missteps. Zaslav reportedly not happy about that article. So I think this all sort of came to a head, hence why we saw his departure from the company. It was interesting. We had Laura Martin on from Needham earlier today. I asked her, is CNN a viable entity for Warner Brothers Discovery? And is this something that Zaslav wants to keep moving forward? And she said yes. She said if you want to be number one in the streaming wars, not only do you have to have entertaining content, but you also should have live sports and news to really keep people there on the platform in case there's any big event. They're leaving Netflix to come to you. So I thought that was an interesting take, because then there are others who say, look, linear TV is declining. Cable news has been really on a downward trajectory. CNN has seen historical lows. So you have to wonder if this is really a good play for this company moving forward.
The viewership numbers were very surprising to me. I was looking at February viewership. CNN almost 4 times lower than Fox in total viewership. It just really caught me by surprise. I hadn't looked that closely at the numbers. And I think it gets to sort of what is next for them in the sense of, yes, having live news is good when there's news happening, but who are your hosts and sort of creating that talk show style atmosphere that I think Fox has been a little bit more successful at than CNN, as far as having personalities that people continue to tune into when that news cycle is a little bit slower, and can you create that in a digital sense?
Well, I also think it's tough that when you want everyone to get on board with this new message here, or really what is a critical message from the Licht era. We'll see whether or not that changes going forward. But he was really tasked with bringing CNN back to the center, not having so much of those opinionated programs, really turning back to the news to its core. It hasn't proven to be successful yet. They haven't really been able to figure out the right mix of talent, get talent on board. There was lots of talk just about how much of their top talent have been pretty dissatisfied with some of the changes that Licht has made or did make over the last 12 to 13 months. But you mentioned the ratings plummet there, what we have seen, and also just profitability. When you take a look at their financial performance, $750 million in profit last year, down from $1.25 billion the year earlier. So certainly seeing a drop. Also, though, coincides with Trump no longer being president. So there's that caveat.
And also, you have to wonder how much power Chris Licht was really given, right? I mean, you got the sense that David Zaslav was sort of whispering in his ear, whether it was about bringing CNN back to the center. I mean, you know, for those who need some reminding, I mean, he did rise to the ranks through Morning Joe over at MSNBC, then the CBS This Morning morning show, and then Stephen Colbert. So he's got a track record. You feel like a year is really not a lot to do the turnaround, but to your point about whether, in fact, Warner Brothers Discovery is looking at it as a potential spinoff, they've got to boost the value somehow. And it's just not doing the trick right now.
Yeah, and you mentioned them trying to bring it back to the center. They did have the Trump town hall, which had a good amount of viewers, but then just 2 days later, Newsmax outperformed them in terms of ratings, which is a much smaller cable network. So we'll have to see there. And really, as media goes through this entire reckoning, a lot of these companies are searching for profitability. Amazon is included in that conversation. And according to the Wall Street Journal, the company is reportedly planning an ad-supported tier for Prime Video. This will complement its current Prime streaming plans, which cost $15 if you are a Prime member, $8.99 as a standalone service. The company already has a free ad-supported service or fast service called Freevee, and that really gained a lot of brand recognition after the release of Jury Duty, which I was a big fan of. Everyone tune in if you haven't seen that. But it just goes to this story of all these companies trying to find that profitability. And to me, this was sort of surprising, since you think of Amazon, Apple, these big tech giants, they have all this money that they wouldn't necessarily be concerned about this. But even they are exploring different types of options right now.
You figure, why not add an extra lever, right? Because if the competitors are doing it, that means that you're becoming a little more accustomed to having those ads. I personally still can't do that. I have tried, but why not have an extra source of revenue?
And you're building out that sports arm potentially too, right? And ads is such a big part of that with what they're doing with the NFL, and so to be able to do that. I also think just ads are part of what Amazon is used to doing. You go on shop on Amazon, and even though you're a Prime member, you still get banner ads up on Amazon, and Amazon's very good at that part of their business. So not totally surprised, at least from my end, to see that. I am curious to see sort of where they go with it in the sense of ads. We were just talking about CNN, not saying that they're going to buy a spinoff of CNN, but do you start getting news then too on Amazon? Like, what other content are they looking to pair with the ads? I mentioned sports, but you would think some kind of maybe live news element or something else that does have traditional ads would be interesting to see if they start incorporating that kind of content too.
Yeah, and it's also interesting you brought up the sports aspect of it, because that would almost be more consistency than across their video offerings, right? They already have viewers who are used to seeing ads when it comes to their sports offerings, their partnership there with the NFL, so more consistency there. And also just overall taking a step back as to why they wouldn't. It seems like a relatively easy feat in order for them to accomplish. And Netflix and Disney, as it seems like so far, the feedback from the street is that they are very successful in converting some of their people who weren't signing up for their own accounts, now that they are doing the password crackdown. Many of those users are signing up for that ad tier. So they're able to get more and more, especially in this economic environment, inflation, people pulling back on spending. Some of those cheaper options, although this ad tier here could be a smart move then.
And it's the part that comes with Prime, right? It comes with like a traditional Prime membership. Because then I think it's really a good pitch. If it's my traditional online Prime membership, and then I get the ad supported tier with it, but I would have to pay more to not get the ads, it's easier to then make more money off me, who was previously getting premium content without paying more, right?
Also, with a lot of competition in the space right now, the Netflix password sharing crackdown, I know I'm probably going to have to, unfortunately, pay for my own subscription soon in order to watch Never Have I Ever, which comes out June 8th. That is something that I think people want, right? That flexibility of choice. And I've spoken with a lot of experts in this space who say advertising is the next frontier in the streaming wars, not only because of the competition, but also because of the ability to capture ads from broadcast television, which we know has been on that decline. So something to continue.
I do it for Hulu, and it's not that bad. I don't do it. I haven't opted for it for Disney Plus or for Netflix yet, but Hulu, and you get used to it pretty quickly.
I've tried that thing where the ads start and I just walk away and I try to get something done. Just
it's quick. It's like when you're microwaving something and 30 seconds has never felt so long. That's what it feels like when you're watching an ad.
There you go.
All right, guys, we're going to take a bit of a left turn here and talk about what's going on outside for much of the Northeast. Millions of people under a smoke advisory right now. Smoke from wildfires in Canada have made it feel like the end of days, or what seems to look like the end of days outside in New York City. But of course, this is also starting to affect travel. We have Newark Airport, LaGuardia, Philadelphia, all three of those airports issuing ground delays right now. Visibility deteriorating here throughout this afternoon. And Akiko, this is something when I know you're comparing the air quality here in New York to what we're seeing internationally, some of the most polluted cities, and we're right up there.
Yeah, I mean, I was going to say that because I think a lot of people who don't live in New York will hear this and say, oh, everybody in New York is, sort of freaking out because it is happening in the center of New York. But that image that we just showed, the live image of Brooklyn Bridge, I mean, that reminds me of what we saw in places like Beijing, Delhi, which is right now, the most polluted city in the world. And yesterday, or I think it might have been this morning, New York did briefly reach that point. And so you have to wonder, I mean, the context of all this is, of course, there's wildfires that are happening in Canada. That air quality is percolating downward into here, but is this going to be sort of the new norm come summer, because wildfire seasons are starting earlier and they're becoming more intense?
Yeah, it's a bit triggering too, right? I mean, we just got through the pandemic. Now, once again, we're being told stay indoors, wear your mask. I mean, these images are really scary. And I think when this affects your health, it reaches that new level of, panic a little bit on what the future holds. And in terms of a business perspective as well, I mean, we saw the New York City zoos close early. You have to wonder if the MLB is thinking about postponing some of those baseball games just
Yankees
because.
are supposed to be home tonight.
Right, they're supposed to be home tonight. I mean, you would think that you don't want people to be outside watching those games or athletes running around.
I think it's been interesting to watch the reaction too when you think sort of, I guess, post-pandemic, we can call it, of how people react to something like this too, how quickly it seems everyone outside on the street is now wearing a mask, right? People are talking about just being home for a day or two, and I'm going to go home and not go into the office tomorrow. And we're sort of more accustomed to being able to do that for multiple days. But then you wonder what the business impact is of that, right? Are people now
scheduled the Yankee game, by the way?
Wow,
they just rescheduled the Yankee game.
Yeah.
So, but then you're wondering how so people now are so much more willing to do that, right, and do it quicker. So what impact does that have on travel? Do less people plan a vacation, or not necessarily a vacation, but the weekend getaway that you were thinking about doing over the next week or two? Does that slow down?
Yeah, I mean, maybe there's a bit more tolerance, right? Because people have done that before. But just, sort of bring it back to why we're doing all this. I mean, I think, not to be the doom and gloom person here, but I mean, let's just put this in perspective. More than 400 active wildfires burning across Canada right now. In terms of the scale of the fires, it's 13 times what we have seen in recent years. And then, of course, the country's saying this could be, they're on track right now for the worst wildfire season in history. And it feels like we have heard a lot of those the records. This is sort of the new reality that we're dealing with.
And it's not just affecting the East Coast. This is affecting multiple states, multiple cities, cross country into Canada. So it is a concern, and it's something that I think a lot of climate activists as well are watching very closely.
Yeah, certainly. Millions of Americans at risk right now amid the poor air quality that is affecting a number of states. All right, Josh and Allie, thanks so much for joining us here for another fun edition of the Roundtable. But coming up, we break down the latest in the retail world, also in housing. Are prices set to drop? We'll discuss on the other side.
A new call from Goldman Sachs strategists changing their tune on how much home prices will drop this year. Yahoo Finance's Danny Romero here with us in studio to discuss how much are we talking about.
Yeah, don't expect a big drop in home prices. Goldman Sachs strategists now expect home prices to drop around 2.2% compared to their previous forecast, which was 6.1%. Why the sudden change of mind? The shortage of homes available for sale. That will help bring prices up, and this comes as the housing market has been resilient. Consumers are adjusting to this higher rate environment, and the major headwind will still be the lack of homes available for sale. The short term, they say that'll be a headwind. But data shows that housing starts have rebounded in April after a year-long slump. But again, the tug of war will be between affordability and inventory. That will be the story. And mortgage rates are still pretty high.
Jane, if people are out there looking for a home, they want to buy right now, they're looking for any deal maybe that's still out there. Where are those affordable homes?
Goldman Sachs says that out of the 25 markets in the U.S., 4 of them are considered affordable. That includes St. Louis, Detroit, Chicago, and Baltimore. Also, a monthly mortgage payment there is about 25% of consumers' monthly household income. So I guess that would be considered affordable. But again, Goldman Sachs points out that their economists expect that the 30-year fixed mortgage rate will end this year at 6.4%. And they also anticipate that the Federal Reserve will be done with their policy tightening as well.
Just 4 markets that are affordable.
Yes.
That's going to be pretty demoralizing if you're in the market for a house. Danny, thanks so much for that. Well, the SEC's actions recently taken against Binance and Coinbase could transform the U.S. crypto market, which is largely operated outside of regulation, pushing them to follow the same rules as traditional stock and bond exchanges. Kevin O'Leary Ventures chairman, sat down with our Yahoo Finance morning team to discuss the latest in the crypto world. Take a listen.
I take a different view than others perhaps on this. I'm actually happy this is happening because from the potential of this asset class, it has been stymied, it's stuck in the mud, if you want to use those words. It hasn't gone anywhere for 3 years because there has been absolutely zero institutional interest. And so people ask me, well, why is it that Bitcoin, which is probably the best index for crypto valuation, is stuck between 25,000 and 30,000 in perpetuity? Because there's zero institutional interest. And so 97% of all the world's wealth in terms of it being invested is done through sovereign wealth or institutional investors or indexed in the S&P 500, or 60% of the S&P is now ETFs. And none of this is carried in crypto. You don't find crypto anywhere. And so while it's been great to be part of this wonderful nascent community and cheering on this idea of a rogue nation of crypto trading, it's worthless because the asset class is a nothing burger today, and it will remain so until we resolve this issue. And so now we go on to this litigation. We've got 2 major claims here. Binance is completely different than the claims made against Coinbase yesterday. These are 2 different situations, and they need to be looked at differently. But overall, I welcome it.
So are you then long-term still very bullish cryptocurrency, as we were talking about even last year, and even in this interim period of time during the crypto ice age? How much has that impacted your own holdings? How much have you lost as a result of this interim ice age that we've seen in crypto?
Well, some of my losses had to do with FTX.
Sure.
Basically, all the whatever you want to allege to that, it'll have to go to trial, et cetera. But the asset class itself still has tremendous potential. So what I've done is reestablish our positions up to a 5% weighting. But I also realize at this point that we're going nowhere. We are not going to advance the cause. We're not going to get any capital appreciation. It's just not going to happen until the very first institution calls me up and says we're going to put a 50 basis point weighting in a $100 billion fund.
How does what has been happening clear the path for that? Because it seems what the SEC has effectively done, let's leave Binance to the side for a moment, right? Because there are some Binance-specific issues. They've effectively said all the tokens have to be regulated as securities. Does that sort of then negate the market for tokens in the U.S.? Does it just make Bitcoin valuable? What does this do to the landscape exactly in the wake of this?
Well, let's read the room. Let's go to Coinbase. Let's talk about butting heads for the last 4 years with the regulator. It's now crystal clear what Gensler wants. He is calling it a broker-dealer exchange, period. There's no grayness. Now, if I'm on the board of Coinbase or I'm a shareholder, which I'm not, and I certainly have almost taken all of our capital out of there, I have zero interest as an institutional investor in putting 1 cent into an exchange, a service, a centralized wallet that is at war with the regulator I serve every day. I have no option but to serve the SEC. If I want to issue securities, I want to participate in financial services, whether I'm here in New York or I'm in Abu Dhabi or London, England, or in Zurich, we all play by those rules. We have for decades. We understand the rules. We built it into our systems. We report to it. There is no optionality there. And then you say, here's an asset class you're interested in investing in, but while you're at it, we're going to war with the SEC. So you can invest with us and we'll go to war. Our fourth battle with the SEC, maybe there's a new idea. Here's a new idea for you. How about swapping out the management of Coinbase, finding a new leader that doesn't want to be Don Quixote in front of windmills and constantly fight a regulator that's told him 3 times no. The answer is no. And I hear it, the rest of the world hears it, but apparently he doesn't. And I hate to be critical, but why can't we find a leader that wants to sit down with the staff and Gensler himself and say, okay, worst case, hear me out on this. Let's agree Bitcoin is a security. Let's say USDC is an actual equity that pays a dividend, okay? Let's treat USDC as not a speculative asset, but when it pays yield, that's interest income. If you want to lend a token, that's a dividend. And it's a security. When you up or sell, if you sell it or you don't, or you make money, you don't, that's a long-term or short-term capital gain. What's so wrong with that? Why not agree to that and then have $1 trillion come into the market once you've had that agreement? I'm okay with whacking Brian, he's a great guy, putting someone else in there.
He's a great guy. We can get rid of him, but he's a great guy.
He's a pioneer, but if he worked for me, I'd fire him. I don't want to go to war with Gensler. That's a really bad outcome for me. They've decimated their stock, they've decimated their market cap, and they want to do it again? I mean, that's just insane.
Just to put a fine point on that, you've essentially kind of decreased your positioning or your portfolio weighting of cryptocurrency now from 20%, which is what it was maxed out at last year, down to 5%. That's one technology. Where else within your portfolio are you looking across some of the cutting edge technology, generative AI even right now? Do you chase the FOMO trade in AI?
I don't chase it, but I already own those names. I've owned the semis, I've also owned Microsoft, I've owned Google. These have been names that are part of our portfolio and have been forever as equities. So we've enjoyed this extraordinary run on tech. We have an index that does that. So I'm not worried about that exposure. You're right, we've taken down crypto a lot while we wait out the war. We're at war now. And so Binance is a, I'm actually, it would be great to resolve this. Let the last shoe drop. Binance has that BNB token. If it goes to 0, it's FTX all over again. And once this is over, and once we've agreed that these are securities, and once we've agreed that these are broker-dealers under the same rules that everybody else has to operate, we have a new nascent industry that's going to take off again. This should be considered a rebirth, and I'll take my asset allocation back up to 20% when that occurs. What's wrong with that? I mean, this story's getting boring. It's getting boring. Hey, let's fight the Securities and Exchange Commission one more time. Sure. What a stupid idea.
Our thanks to Kevin O'Leary there, as well as Yahoo Finance's Brad Smith and Julie Hyman. Well, coming up, we get you caught up on a few trending tickers that are moving after hours. Stay tuned.
the SEC suing Coinbase this morning in the Southern District of New York for failing to register its trading platform with the agency, alleging that it was an unregistered national securities exchange, broker, and clearing agency. The SEC also bringing charges against the largest U.S. crypto trading platform for failing to register its crypto asset staking as a service program.
25,000, which is actually a little bit below here, was a floor. That's a big historical area for Bitcoin. It has not yet reclaimed yesterday's high. And so this is factoring also the news we got yesterday from Binance.
Coinbase was involved in staking in general without registering a staking platform with the SEC. In the eyes of the SEC, staking, the action through which proof-of-stake tokens are created, is in itself a means through which securities are created and exchanged. And that really is one of the big questions now with regard to Coinbase is, will it be able to pivot overseas? In the first quarter, the US represented about 86% of Coinbase's net revenue. That is not an easy pivot to execute.
I think the questions out there is what are actually securities and not securities, and do SEC actually creates a pathway and say this is how it should work?
The agency says it's acting as a broker, an exchange, a clearing agency, and also a seller of securities. They say as a result, Coinbase is then evading disclosure laws that were specifically set up to protect consumers by Congress. This is the 14th case that the SEC has brought against crypto entities since January.
Bottom line here is if the SEC doesn't completely shut down Binance and Coinbase, probably not going to derail crypto, but if in fact the Coinbase business model cannot survive with SEC regulation, well, that's a different story altogether.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And we can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Let's take a look at two trending stocks here after hours. We have GameStop and Rent the Runway. Kicking it off with GameStop, we're looking at share declines of just about 20% here in extended trading. A couple of big headlines from this earnings release and also a separate release that we got here from GameStop. First and foremost, the board elected Ryan Cohen, executive chairman, former CEO of GameStop, has also been terminated. Matthew Furlong, no longer a part of the company. The board also cutting its members down to 5 members. When it comes to its most recent earnings release, they did miss the street's estimate on sales, also not holding an earnings call today. We're looking at losses, Akiko, of just about 20% here in extended trading. But Ryan Cohen now executive chairman of GameStop.
Yeah, I mean, Matt Furlong just at the helm for 2 years. I mean, this is a company that has been trying to slash costs, store closures, job layoffs. Simply still can't turn it around when you think about where GameStop competes. Can we point to a Ryan Cohen tweet, though? Because he does tend to do this where he puts out a cryptic tweet and then it has us asking, well, what exactly does it mean? This is all he put out here saying not for long. Does it mean he's not for long as executive chairman? We don't know. But it's certainly the stock taking a hit when you think about where things are right now down.
Or does it mean that GameStop's not going to be around for long? Because lots of questions just about the fundamentals of this business, what exactly it looks like going forward. If you take a look, if I throw up a 3-year chart, I think it's going to best illustrate this here. Obviously, GameStop has been one of the names, one of the leaders here within the meme craze, the meme trade. You can see the spike initially back in 2021, over $75 a share. We're still trading just around $25 a share, but certainly a very, very volatile stock here. And let's also take a look at Rent the Runway, the retailer that rents out clothes. I'm one of those subscribers here. That stock off just about 10% here in extended trading. A disappointing guidance number here from the company. Second quarter sales forecast falling a bit short of what the street was looking for. When it comes to the first quarter numbers, they're actually relatively strong. First quarter earnings, revenue, beating the street's expectations just over $7 $74 million, a record high number of subscribers, up 15% on a quarter-over-quarter basis. But Akiko, Rent the Runway has really struggled in consistently building that subscriber base, getting people to resubscribe to their service, given the fact that people are pulling back on spending and they're also just venturing back out into what they were doing pre-pandemic.
Yeah, I mean, you think about the expectation that has shifted over the last several months. We've heard from some of these retailers that people are starting to go out again. People are attending weddings. They're attending big events. I mean, the expectation being here that Rent the Runway can capitalize on that. To your point, it's not that they haven't done that, but the outlook doesn't look good. And the question, I think, for a lot of investors is going to be, well, what is that next lever? Is it about sort of mass fashion, something they've been asked about before, and they've said this is kind of the model that we are sticking to, but the outlook's certainly not strong enough for investors to say, look, we think things will get better.
Yeah, I think investors still have a lot of questions. What was also interesting in this earnings release, we talk a lot about return to office, and they were saying that demand for office work attire has really spiked in the last several weeks and most recently in the last quarter, but they're also planning to increase their workwear purchases by just around 50%. So that really speaks to the overarching trend that we've been talking about, clearly one of the drivers here in this most recent earnings results. But the guidance was the miss here, and that's why we're seeing the stock off just over 10%.
Okay, well, it is closing time here at Yahoo Finance Live. Here's a look at some of the top stories of the day. GameStop making some major changes in leadership. The company firing CEO Matt Furlong and naming Ryan Cohen as executive chairman. But GameStop isn't saying why Furlong was fired. The announcement coming just ahead of earnings. The stock plunging in after-hours trading.
And CNN facing its own leadership change. Chairman and CEO Chris Licht stepping down after a tumultuous year in the job. Licht struggled with programming changes, low ratings, and shuttering CNN Plus. While CNN parent Warner Brothers Discovery looks for a permanent replacement, the network will be run by a trio of executives. Shares of WBD jumped more than 8% on the day.
And finally, one Amazon analyst is taking an activist stance. Bernstein's Mark Schmelik writing an open letter to Amazon CEO Andy Jassy saying the company needs to refocus because it is, in his words, pursuing too many ideas. Schmelik says that if the tech giant makes changes, the stock could hit up to $200 a share. Despite the critique, Bernstein has Amazon as its top pick with an outperform rating and a $140 price target.
All right, well, that will do it for us today on Yahoo Finance Live. Be sure to come right back here tomorrow, 3 p.m. Eastern Time. We've got your coverage leading up to and after the closing bell. Have a good night.